Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow, Chicagoland Retirement with Chicagoland's CFP certified financial planning professional. Tim Stearns here with us as always, providing guidance and insight, perspective, and education on the financial world, helping to uncomplicate the difficult decisions that we face with our money. And Tim, we always appreciate the time, the knowledge, the information, and perspective that you do share.
Well, Peter, thanks for having me here. Good to talk to you and to talk about some things that a lot of people either like them or hate them, and it's annuities. So let's get down to brass tacks.
All right, diving in. Yeah, much discussed. And it seems, Tim, that these are either made out to be the best thing since sliced bread and the financial solve all, or something that you should never consider or go anywhere near. I find either one of those extremes kind of hard to digest and imagine. I think that every financial tool probably has a time and a place and a purpose that it can serve. No financial tool is all benefits with no disadvantages. We really just need to weigh things carefully for our situation and figure out what is the right and most appropriate tool for our situation.
Yes. And back in 1994, when I got in the industry, our flight to safety was bonds, right? Well, nowadays bonds carry their own inherent risk, especially with the Fed moving rates up. So what I'm finding with annuities, they're kind of my new fixed income portion for my clients. If we're doing an income allocation plan, it helps prop up the retirement payments to them. Their stream of income that's guaranteed in some cases, so that they know exactly each month what kind of money they're getting. And then we have a growth bucket doing its thing in the market. But at the end of the day, I don't know where else to get anyone a guaranteed fixed rate on something that's worth a darn nowadays because of rates being so low.
Yeah, with bonds, Tim, and the low interest rates we have seen, they aren't paying a whole lot, maybe 3 or 4%. And that's if you get into a good bond fund or an actual individual bond that's maybe 10, 20, 30 years till duration, right. Meaning that during that period of time, your value can fluctuate. It can go up and down with the market. And as interest rates rise, we know that inherently presents bonds and bond funds with some difficulty and headwinds and the likelihood of losing value. Whereas with annuities, are you able to get a little bit more of an assurance of principal protection, preservation, and possibly a higher growth or income rate?
Well, yes. The quick answer is yes. But one thing I want to back up to is that with the Fed saying that they're going to raise rates up to 1% in July, by July, excuse me, then you have, for every 1% that they raise rates, bond mutual funds lose about 9% on average. All right. So we're seeing that. And at the end of the day, if you're in an annuity with a fixed rate or what have you, that you're going to be getting that, so there's no variables, and I don't know where else to get that value for people, and to have the common sense approach to this, that we just need to pay our bills, right, in retirement, and have the extra money for the things that we didn't get to do when we were all working.
Well, again, you've got to examine all of the tools carefully. And if you would like to sit down with a certified financial planner, if you'd like to find out about how to structure an optimal portfolio for your goals and your situation, take advantage of that Protect and Grow planning strategy session. It is a comprehensive review of your financial situation, a detailed forensic analysis of your current accounts and holdings, and then a discussion of how to align the two, the goals and the money, and make sure that your money is working hard to help you achieve those goals. 800-640-2256. That's 800-640-2256. 800-640-2256. So Tim, finding the solutions here with annuities, looking at what they can and cannot do for us. You are mentioning that you are looking at them more and more as a suitable bond alternative, oftentimes lowering the risk to the overall portfolio and increasing either the growth or the income that the portfolio can generate on a secure basis.
Right. And I mean, what we do is we show people what the returns have been over the last 20 or 30 years, with these annuities, to show them what their income is going to look like. Thereabouts, is it to the penny? Of course not. But it shows them the stability, the rate that is going to come in every month of what their income is going to look like. And it's been proven that people who know where their next payment's coming from sleep better at night. Who wouldn't want that? And you have people who say, oh, annuities are terrible. Usually they don't know the specifics, or they see an article about a variable annuity, which that's not what we're speaking of. We're speaking of fixed index annuities, which is where I think is a good alternative to a bond like we talked about.
And there have been many articles recently, Tim, that I think shine a much more favorable light on annuities, talking about the reality of market volatility and what impact that can have mentally, emotionally, psychologically on retirees who have their life savings in the market and just watch it ping pong and go up and down given the day, given the times, versus somebody who's got that stability, the principal protection that can be offered, the guarantee of income. And Kiplinger recently came out with an article, annuity payments don't make your retirement, they make your retirement better. I think that seems to be the overarching theme of a lot of the information that we have heard about annuities recently, is that they just add a quality of life and peace of mind factor.
Well, yes. And the Secure Act, which came out in 2019, also allowed the ability for plans to add annuities to their programs. So companies can have annuities within their 401k. I mean, everyone's getting involved here. And I think that's the reason, is that people have moved far, far away from having pensions. So where do you get that stability of that income that that's coming in every month? Well, it's an annuity, and I'm not talking about a variable annuity that would be tied to the stock market and it goes up and down. And as you say, ping pongs, this is something that's stable. We're just trying to get maybe a 3 to 5% return on it, but I know that it's coming and it makes me feel better about my retirement.
Well, Tim, let's back up if you would. I think that people tend to shy away from things that they may find complicated or not understand at a fundamental level. Let's take a 30,000-foot view and then zoom in from there. Talk to us, if you would, about what an annuity is and fundamentally, what are the values of an annuity, or considering an annuity, what would we need to know and maybe be careful and be aware of?
Well, annuities have been around since the Roman times. Okay, so they're not exactly new to the street here. But basically, what we're seeing is annuities can come out in different areas. There could be fixed annuities, which will pay you a given rate forever and ever. Okay, you have immediate annuities that pay you out based on whatever the interest rates were that day. And then you have variable annuities, like we said, that are tied to the stock market. I'm not a big fan of those. In fact, we don't do those here. But the fixed index annuities kind of combines the fixed areas as well as the ability to have growth. The worst you can do in a fixed index annuity is usually a zero. So if the market's down in 2008, 36%, you're at a zero. Zero is the hero is what a lot of people say. So I like that. And what it does is it builds an income. A lot of them are tied. They mirror the market, I should say. And by mirroring the market, you're going to get some of the return, but not all of it that the market did. But here's the best part. You won't have the risk.
So you talked about the bond portion of the portfolio. And I guess here would be the question is, should annuities be thought about as a supplement or replacement to bank money, to stock market money, to bond money? Where do they play the role? And I know you've talked about buckets before, like, right. Do these have their own specific kind of strategy bucket in a comprehensive plan?
Yes. So if we have a baby boomer come in to meet with us, a lot of times we're going to use an annuity. They are introduced in 1978 to 401ks. They don't have a defined benefit or a pension. So we need to shore up that side of the area. You know, you have your growth from the stock market, but you have the annuities actually doing the job of the bonds that used to be out there that, you know, gave a good return. Now we have, you know, bonds that are not returning well with risk. You know, you can't count on that for your retirement consistently.
We hear, though, Tim, that annuities are so complicated, and you did mention several different types of annuities. Are the sheer number and the different types the complicating factor? Why do we find these vehicles to often be so complicated?
Well, I think people shut down a lot when they hear the word annuity. That's why one of the things I like about the book that we use, which, you know, we're going to give out the first 10 callers a free copy of the book. It defines all the different annuities, you know, and I tell people, you know, let's not be ignorant. Let's actually look and, you know, make an educated decision as to whether you want an annuity or not and what kind you want. You know, the devil's in the details, a lot of people say, but if you can break it down like the book does so that people understand it, you know, I think it, you know, then you can comfortably make a decision, yay or nay on it. And that's fine by me.
Well, again, if you would like to get questions answered, if you'd like to address specific financial concerns, if you'd like a comprehensive review, pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256 to speak with certified financial planning professional Tim Stearns, Chicagoland CFP. Again, 800-640-2256. Tim, the things that I don't find complicated: I don't want to lose money. That's not very complicated. I'd like to be able to count and rely on my income. That's not very complicated. Not a lot of vehicles can offer that level of simplicity when it comes to things. I mean, bank accounts can offer a factor of, I don't want to lose money, certainly, but then they aren't growing very much either. And if you take a reasonable chunk of income out and you're not earning that back, then your account value is going to decline. If we are shooting for market-based returns, maybe other options do make sense if we're comfortable with volatility. But there are parts of annuities that are very simple, and then there are parts that are more complicated.
Right. And again, this is defined in the book, and I would tell anyone who wants to understand that, give us a call and we'll get the book into your hands. Because it defines all those different things. So there are a couple things. A lot of people deal with what they call the spread. And the spread is essentially what after, let's say the spread is 2.5%, like it currently is. All right. After 2.5%, that client can earn the rest that the market did. So there's your, if you will, your fee. Okay. So that's one way of doing it that we like. You know, if people think it's going to be a good year for the stock market, we'll do that. And then they can, everything after 2.5% is theirs, or there's a cap. So let's say the cap is 6%. If the market does 10, you're going to get 6%. And those are two of the more familiar ways that people do it, you know, that I would advocate for. But I mean, they're not that bad. You know, you need to understand them and then make your educated answer to that. The other thing we see is that people say, well, I'm losing control of my money. The insurance company has all of it. That's not true at all. You can take out 10% a year. You can, you know, turn on your income and still have your income coming in, but you can control, you know, when you're getting it, you know, the first, the middle of the month, the end of the month, etc. There's a lot of different things, but you know that you're getting a protected income that comes in monthly, and it helps you sleep better at night.
I think bottom line, Tim, is that mutual funds are pretty complicated. Bond funds are pretty complicated. ETFs are pretty complicated. All of these different options have details that we may not know the full implication of. We may not have 100% of all the facts and information. I think very few people read every page and understand every word of a prospectus when they get into a mutual fund or invest in their 401k. Here's kind of the uncomplicated part is with those market-based type of investments, if we want to get out of them, we generally can get our money out within a relatively short period of time, maybe the close of business that day or the close of business the next day. If we've got a mutual fund we think has gone out of favor, we no longer like it. If we've got a dog stock we just want to sell out of, we can do that. Whereas with annuities, kind of getting out of them can have limits and limitations. And that may be a little bit more of the complicated part on top of those caps and spreads and ways that we're only sharing in the gains of the market. But I'd probably gladly give up some of my upside if I was completely protected against the downside. That trade-off may be rather simple and uncomplicated, actually.
Well, the whole idea here is that it's a long-term investment for, retirement, a 30+ year retirement. It all comes into there, so you have to have, you have to understand that your ability to earn income is important, and you need to have inflation in there. When the market goes up, there are actually increases in the payments per month. So that's a nice thing. But the most important part is that, yes, it's a long-term play, but they're committed to you. Most of them have lifetime income riders that if God forbid you pass, if there's any money left in the bucket, we'll call it, it goes to your family. A lot of people think that if they put it in an annuity and they take one payment and they pass away, it goes right back to the insurance company. That is not the case. These are someone in the Smith family, if they put money in an annuity, will get it back, whether it's the husband or the wife or the kids. So, or whatever beneficiary you want to use. So these are things that I think there's a lot of misconceptions. And that's why, I think the book sets them straight as to why that is.
Well, again, if you would like to get a detailed, thorough, comprehensive analysis of your financial situation and then put together a true plan for retirement, a written retirement income plan, in many cases with certain contractual guarantees for the income that you can count and rely on durably throughout your lifetime and into the future. That is part of the Protect and Grow planning process there with CFP Tim Stearns, Certified Financial Planning Professional. Tim Stearns does offer the opportunity for podcast listeners, radio show listeners, the viewers of the podcast today. You can simply call that number, 800-640-2256, 800-640-2256. Ask a few direct questions if you'd like to get started, and then set up a time that's convenient for you to have a detailed one-on-one discussion with Tim Stearns about your situation, and make sure that your money aligns with your goals and that you've got a plan for your dollars to work as hard as you have for them to help you achieve your financial goals. We're talking about moving your money and your life into, to, and through retirement, and especially during that retirement red zone where we are within earshot of retirement. The first few years leading up to retirement, the first few years after retirement, we don't want to suffer significant volatility with our life savings. We don't want to see large portions of our life savings disappear without us having anything to show for it in market volatility. And a lot of people are reasonably concerned about that right now. Again, that Protect and Grow plan and the financial and retirement review and strategy session with Tim Stearns, a great opportunity for you to look at all of the options and consider them for their benefits, their disadvantages, their appropriateness for helping you achieve your goals. 800-640-2256. That's 800-640-2256. Tim has also mentioned the book that we are giving away. That book is Income Allocation. It is a modern strategy guidebook for retirement, an essential guidebook for retirement that is being used by advisors and by individual investors across the country to understand better the modern difficulties that we face in planning for a stable, secure, confident retirement, and then addresses the way that the traditional financial system actually enhances those concerns, actually increases those concerns, and the way that we can specifically structure the assets to address and minimize many of those risks that create the concerns and uncertainty. If you would like your copy of Income Allocation, pick up the phone and give a call now, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, I do hear some marketing out there, some rallying cries kind of against annuities. And every time I hear them, here's kind of what I think in my head. Well, I hate losing money, and I think a lot of other people do too.
Right. So some of the questions that we ask, that our clients are asking us, can I lose money? No, it's principal protected. Okay. Will I pay a lot in fees? I mean, the average fee on a mutual fund nowadays is about 1.44%. These fees are much less than that. And these are tactical indices that they're using. So they actually go in and out of the market. There's a couple of them that are excellent that I use. Will my cash flow fluctuate? We always tell people your first check is your worst one, right? Because if there's a gain in the market, it actually goes up with inflation to stay above that level. Will you be able to keep your money if one of us becomes ill or passes away? If you become ill, a lot of them have income doublers that you can actually turn on. You don't have to show insurability for. You could actually be terminal and be able to do that.
And Tim, I think that's where a lot of the ongoing concern with annuities has been and has generated from is that liquidity issue. Well, what happens if I get sick or ill or have an emergency and need some money? What happens if I pass away? The way that many of the older types of annuities behaved is that liquidity was not available, that inheritance value was not available. Similar to the way, by the way, that Social Security and pensions from companies, traditional retirement pensions, behaved, in that if you passed away, the money goes back to other people who have outlived life expectancy. It doesn't go to you and your family. You got to remember that about those two systems. While we enjoy and appreciate the income that Social Security and pensions can generate and the reliability of that income, it's not without risks and downsides.
Right. And, people enjoy Social Security having that monthly payment, and then they, get all upset about annuities, which in most cases, they just don't understand it. These are guaranteed streams. And if, let's say you take one payment and you pass away, either your spouse takes it over or you leave it to your family or whatever beneficiaries you want. So the money ultimately is not the insurance companies. I mean, are they going to use it while you're with them? Of course. But they're going to be paying you out a steady income every month. It's worth looking at. Kick the tires, take a look, and see if it's something that works for your retirement income plan.
Well, again, we are talking with certified financial planning professional Tim Stearns, CFP. If you've got questions or concerns, if you would like to find out more about how to get that principal protection, add a little bit more certainty and confidence into your financial future, into your retirement picture, pick up the phone and request the time and the opportunity for that one-on-one conversation, for that comprehensive financial review and strategy session, and to get your written retirement income plan, that protect and grow plan in writing, to make sure that your dollars are working to help you achieve the goals of reliability, durability, consistency for income into the future, and the confidence that that can add to your retirement picture. 800-640-2256. That's 800-640-2256. 800-640-2256. I didn't mean to jump in there, Tim. Are there any other big questions that you get asked about annuities often, or that you feel should be addressed in a general sense of the questions on annuities?
Well, a couple of them, my mom used to ladder CDs, and one of the ones I'll get is, can I potentially get higher income by laddering annuities? Yes. It depends on what the interest rates are and that type of thing. But we explain that to people when we're doing their income allocation plan, that this is what we're using as our income. No longer are you receiving a company paycheck. You're receiving a check from the insurance company. It's every month, rain or shine, it comes. And I know many of our clients are very happy that they know on whatever day of the month that they're getting it, it's going to be there, and it's principal guaranteed and the returns are guaranteed.
Boiling it down, Tim, what do you feel are the best uses, the biggest strengths of annuities?
Stability. And I think that is huge, because when you're in retirement and the market's going haywire like it did at the beginning of this year, and you still know you're getting your bills paid, that's priceless. You can't put a price on that. I think that makes people feel good and sleep at night. That's, my father was on a railroad pension. Now my mom gets half of it because he's passed away. I know that made him very comfortable to be able to retire. And my mom is very comfortable as well.
And then on the other side of that, what do annuities maybe not do? Where is the wrong place to consider an annuity?
Well, if you're going to put money in there, you have to expect that it's going to be like, a 10-year, in a lot of cases, a 10-year commitment. But if you're putting money in there, that's retirement money. I mean, you're in a 30+ year retirement. What's 10 years to you? It makes sense to do that so that you have the stability. So you're locking up money that you wouldn't have. I love people who come to us with let's say $500,000, and well, I don't want to put it all in an annuity because it's going to be all locked up. You're going to tell me that a 401k or an IRA, you're going to take $500,000 out and pay the taxes on that right off the bat? No, you nibble on the tax bill, and that's annuity does that too. And it also satisfies required minimum distributions that people have to do when they're 72 years old. So we're killing a lot of birds with one stone.
And then just as an additional benefit, Tim, you discussed before the program that certain annuities also can potentially have some healthcare benefits.
Right. So a lot of the ones that we use, if you can't do 2 of your activities of daily living, then you are able to actually turn on the income and double it. And they'll pay out until that money's no longer in the account to take care of your care. So if you're certified that you can't do 2 of your activities of daily living, and that's from your own doctor, not an insurance doctor, from the company or anything like that, those things that they're there for a reason. It gives stability, and that's what people need in retirement. That peace of mind.
And Tim, the important factor is until it runs out of money, but then it continues paying you an income for life. And any other option, any other choice of financial vehicle, you could pull out more income. But once you hit that zero balance, you're out of lump sum, you're out of income. With that annuity healthcare option, as you were talking about, it continues for life.
Right. And I mean, lifetime income is priceless. A lot of us are not going to have access to pensions, and, most baby boomers do not. Well, take a look at an annuity then. If you feel like that would give you stability and peace of mind, that's the way to go.
Well, if you are not sure if you have a retirement income plan, then chances are you probably don't. If you are not sure you have a written plan with contractual guarantees that you can depend on for reliability and consistency of that retirement income, then your retirement income likely is subject to market conditions and fluctuations. And at TJ Stearns Inc., certified financial planner professional Tim Stearns can help you construct a plan, that protect and grow plan for retirement income, a written retirement income plan with contractual guarantees in place. If you would like that kind of certainty and reassurance and confidence for your retirement, give a call, pick up the phone, 800-640-2256. That's 800-640-2256. And Tim has made that book, Income Allocation, available to the first 10 callers to the program today. If you have saved at least $500,000 for your retirement, it is essential that you read this book to understand how to structure the assets to provide for retirement comfort and confidence and stability moving into and throughout your financial future. 800-640-2256. If you'd like to request a copy of that book, you can get it in digital format or a physical book in your hands. Tim will make that available to you. Be one of the first 10 callers only. 800-640-2256. Tim, we always appreciate your time and the guidance that you share with Chicagoland area savers and investors here on the program.
It's my pleasure. Thank you.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.